the hidden system that pays finder fees in real estate transactions. 1. The core concept of finder fees in modern real estate. The contemporary real estate marketplace contains structural inefficiencies that many participants overlook. Within this gap lies a lawful, replicable method by which an individual may generate substantial income without licensure, capital investment, or ownership. The mechanism operates on one principle. Certain real estate investors prefer not to source their own discounted properties and will compensate others to locate such opportunities. So what does that actually mean? It means that the individual acting as a deal finder leverages publicly listed distressed properties and matches them to investors actively advertising their purchase criteria. The initial hook lies in recognizing that thousands of investors nationwide publicly declare their acquisition requirements, often in local real estate groups. The tease is simple. These investors already have capital, already have interest, and already have defined parameters. What they lack is time. The reveal becomes evident when one sees that the finder fee is merely the economic exchange for bridging that gap. This is the problem. Investors cannot source every property themselves. The empathy arises from acknowledging the workload they avoid. The action is identifying their criteria, locating a qualifying property, and presenting it at a price below their valuation threshold. Footnote: this section establishes the economic logic underlying finder fees as a legitimate and necessary market function. 2. Locating investor demand through public platforms. Real estate investment groups on public platforms function as open-source databases of buyer intent. By accessing widely used sites and navigating to group environments dedicated to real estate investing, one can search specific terms such as by box to reveal investors actively seeking properties. The term by box refers to precise, quantitative acquisition criteria, purchase price ranges, acceptable renovation levels, and required after-repair value thresholds. So what does that actually mean? It means the investor is publicly providing a checklist that allows a deal finder to know exactly what to look for before making contact. The process is not geographically restricted. An individual in one state may source property in another if the investor's criteria are met. The value proposition is that the investor signals readiness to pay multiple finder fees per month, demonstrating both demand and repeatability. No license is required to communicate with a realtor on behalf of a buyer to inquire about a property, provided the individual does not publicly market or advertise the property themselves. Footnote: this section demonstrates how publicly available investor criteria provide a blueprint for deal sourcing without regulatory barriers. 3. Identifying properties that match investor criteria. Distressed and undervalued properties are often available on public listing services. The task is to locate properties needing renovation that fall within the investor's after-repair value range. A functional approach includes narrowing search parameters by price, often below market, because these properties typically offer greater negotiation margins. So what does that actually mean? It means the deal finder is not guessing. They are filtering listings to uncover candidates where a discount is both possible and strategically justified. The analysis of a potential offer follows a predictable formula. Determine the after-repair value, subtract renovation costs, subtract desired profit, and identify a price point where the investor would execute the purchase. A simplified rule, offering approximately 70% of listing price, serves as a quick heuristic, though quantitative calculation is superior. The finder generates value by securing a property at a price materially below listing, thereby creating economic room for an investor to purchase immediately. Footnote: this section explains how to identify, analyze, and value distressed properties to meet investor by box requirements. 4. Structuring the offer and securing the finder fee. The deal finder may present the potential property to the investor prior to making an offer, ensuring no risk of the investor failing to perform. Once the investor confirms their target purchase price, The finder negotiates with the seller's agent and secures a contract with an inspection period allowing withdrawal if circumstances change. So what does that actually mean? It means the finder avoids financial exposure while still controlling the negotiation process on behalf of a ready and willing buyer. The investor compensates the finder at closing, typically several $1,000s, because the finder delivered a property at a materially discounted acquisition price. This process is categorized as wholesaling real estate when the finder secures a contractual interest and assigns it to the buyer. However, the underlying principle remains unchanged. Value is created by locating a property at the correct price point. This small-scale arbitrage is repeated nationwide thousands of times per day. Footnote: this section outlines the risk-mitigated structure that enables finder fees to be earned without capital or licensure. 5. Practical validation and demonstrated replicability. The legitimacy of the process is reinforced by verifiable public transactions. Properties acquired at substantial discounts are recorded on public registries and demonstrate the real-world payment of finder fees. The replicability is proven by numerous individuals, including young participants with no prior real estate experience, executing the same method by identifying undervalued listings, submitting appropriately discounted offers, and assigning the resulting contract. So what does that actually mean? It means success in this system does not depend on credentials, background, or location. It depends solely on following the process with consistency. The broader implication is that the marketplace contains thousands of undervalued properties and thousands of investors willing to pay for discovery. With over 10,000 real estate transactions occurring daily in the United States, capturing even a small fraction of these opportunities can generate predictable, high-value finder fees. The hook is the income potential. The tease is the accessibility. The reveal is that the process is entirely grounded in publicly available information and open competition. Footnote: this section confirms that the method is publicly verifiable, repeatable, and available to any participant who follows the process.